Are you ready to learn the secrets of the world's greatest investor? Imagine if you had invested just $1,000 with Warren Buffett when he first started. Your investment would be worth almost $18 million today. Since 1970, he has been the largest shareholder in Berkshire Hathaway. People call him the Oracle of Omaha. Discover how Warren Buffett achieves such incredible returns by following his 6 smart investing principles and strategies. You don't want to miss this opportunity to learn from the best. Make sure to watch till the end of this video to find out all his secrets. Investing principle number 1. Invest without emotions. Make quantifiable financial decisions based on math and facts, not fear or greed. Investing in the stock market may be unpredictable and can require rapid judgments. It's crucial to remember that large market developments can happen rapidly, and sometimes it's preferable to wait before making any decisions. Even experienced traders might get caught up in the moment and make emotional decisions, which can lead to bad trades and lost chances. Long-term thinking is crucial. Investors might be dissatisfied even when the stock market is performing well. Hope and fear often leads to unwise decisions like purchasing stocks when they're overpriced and selling them when they're cheap. This may affect your long-term investing goals. Again, long-term thinking is crucial. It's crucial to regulate your emotions and not make judgments based on gut sentiments to be a successful investor. This entails having a clear plan for your long-term financial objectives, recognizing your risk tolerance, and carefully managing your investments. Investing principle number 2. Understand the business management. Buffett talking to a class, he told them, "You're looking for 3 things generally in a person: intelligence, energy, and integrity. And if they don't have the last one, don't even bother with the first 2. Many of us have intelligence and energy, but the integrity is up to you. You weren't born with it, and you can't learn it in school." Investors, he said, act in very human ways, which is why they become so giddy during bull markets. He also added how investors look in the rear-view mirror. Investors look back, and if they see that they have made a lot of money during the last few years, they get excited to make even more money next year, simply assuming their good fortune will continue. Conversely, when they look in the rear-view mirror and they see that they made no money, they just get despondent, saying that this is always going to be the case. So they don't care about what's going on in the underlying business. It's outstanding, but that's where lies the huge opportunity. Investing principle number 3. When you find a good opportunity, go for it. Warren Buffett once said, "Big opportunities in life have to be seized." We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. But to do it on a small scale is just as big of a mistake as not doing it at all. You really have to grab them when they come, because you're not going to get 500 great opportunities. To complement this message, Warren Buffett mentioned this next analogy during a lecture he gave to the University of Georgia Business School students in 2001. When it's raining gold, reach for a bucket, not a thimble. This approach to investing underscores just how focused Buffett is when it comes to investing, and highlights how we should all seize and capitalize on big opportunities when they come our way. Investing principle number 4. Buy great businesses. Warren Buffett was once told by his mentor to buy things on a quantitative basis, to look around for things that are cheap. According to Buffett, this made a big impression on me, so I went around looking for these terrible looking, ugly and cheap companies. So that's what I did for years. However, it was a mistake. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Warren Buffett. Before we go any further, you should remember that success doesn't always happen right away. It can take time to grow or show up in your life. Even if you only use a couple of these tips, they will help you, but only if you do them regularly and consistently. Keep watching to learn more investing principles from Warren Buffett. Investing principle number 5. Never buy stocks that you do not understand. Don't chase stocks you don't know anything about, just because everyone else is trading them. Know your circle of competence and stick within it. The size of that circle is not very important. Knowing its boundaries, however, is vital. Warren Buffett. There are an infinite number of reasons you might decide to invest in a certain company. But Berkshire Hathaway CEO Warren Buffett says there's one thing you should always avoid: buying a stock merely because you think it's going to increase in price. That's because nobody, not even the best investors, are able to predict how the market will perform. Instead, you should invest in companies that you both understand and believe will offer long-term value, according to Buffett. He also said that no matter how much or how little you're buying, you should be able to get your reasoning down on paper for yourself without relying on other people telling you that it is a great investment. Investing principle number 6: hold for the long term, unless the business fundamentally changes. Berkshire Hathaway's 2002 shareholder meeting, Buffett responded to a question about when he'll decide to sell a stock. Our favorite holding period is forever. Buffett mentioned two main reasons he'll sell a stock. The first is when he feels Berkshire needs the money for a more attractive opportunity. We would sell if we needed money for something else. I would reluctantly sell something terribly cheap to buy something even cheaper, said Buffett. This doesn't happen to Berkshire too often these days. After all, the company has more than $100 billion in cash. The second and more common reason Buffett sells stocks is because of changing fundamentals or a changing competitive landscape. The bottom line: selling stocks is fine if you do it for the right reasons. Sell because a company has fundamentally changed or because you can deploy your money more effectively somewhere else. Don't sell just because everyone else is or to lock in a quick profit. You have just learned Warren Buffett's 6 investing principles. We're going to wrap things up here for the day. We hope you enjoyed the content of this video and gave us a thumbs up. Thank you for watching. If you want more information on the tips to make the most out of your money, check out our other videos on the screen.